Welcome to the Team Coyle podcast. I'm Matt Coyle. I am a real estate agent at Compass, Team Coyle, and I have the privilege of being here with Ivy Jiang, who's a 20-year veteran in the banking industry, 7 years in mortgage loans, and you're at Washington Trust. Hi, Ivy. How you doing today?
Hi, Matt. Thanks for inviting me over.
Don't look at the camera. The hell with them. No, I'm kidding around. But
Sure.
yeah, no, thanks for coming. Thanks for
You're
coming.
welcome. You're welcome. Yes. I'm glad. Thanks for the opportunity. I love to come and to share with you guys, about the new changes come up. Started yesterday actually, so we can talk about it, and then hopefully my informations and can help the buyers on the market who's looking for mortgage right now.
Yeah, no, it's a crazy time to be buying or selling a house. I guess it's better to be selling than buying because there's not a lot of inventory, but there's still good opportunities out there. And
Of course.
and just so you know, Ivy and I met at this Chamber of Commerce event,
Yes.
Charles River, I think it was,
Charles River, yes, Charles River Chamber.
over here in Wellesley, Paparazzi, and we started talking about this May 1st change that was coming down the road. Both Fannie and Freddie are now changing the mortgage fees,
Yes.
and there's a lot of, what's the word I'm looking for? A lot of disagreement of whether it's good or bad.
Correct.
I think David Stevens, who's the former commissioner of the FHA, basically accuses, I guess, probably too strong of a word, but basically says that it's like robbing Peter to pay Paul. In other words, the people with the high credit scores are getting penalized, and the people with the low credit scores are getting rewarded. Sort of like a politicization of the mortgage loan business.
Right.
Whereas I think Sandra Thompson, FHA, the Federal Housing Financing Authority.
Yeah.
She's the director there. She says, no, we just did a recalibration of the risk. It's now better aligned. We looked at the data and we just made some changes that were long overdue. So I don't know what it is, but let's talk about it a little bit.
Sure. Yes. Let's talk about it and see what the changes can affect the borrowers.
So that's you and all your information. We'll put that at the bottom of the video so everybody can contact you.
Sure.
I'll certainly going to be recommending you to some of my clients.
Thank you.
Let's first talk about LLPA. What is that? So for the average person, we don't understand that. So
Sure. So the LLPA definition is loan-level pricing adjustment. So here, this is the chart for 2022. Before, it's pre-May 1st, what the loan-level pricing adjustments looks like for any Fannie Mae type of a loan. So Fannie Mae lenders, Fannie Mae size of a loan, any loan amount that is $726,000 below will have to follow these adjustments here.
So this is for single-family homes and for loan values of 726 or below.
Correct.
And then just so it's clear, on the left-hand side you have the FICO scores, the credit scores, if you will.
Yep.
And then across the horizontal axis, if you will, the loan-to-value ratio.
Correct. This is the loan-to-value ratios, and then that's the credit score on the left.
Which is the reciprocal of down payment. So there you go.
Correct.
So basically, this was the adjustments that loan officers like you made to mortgage or borrowers looking to borrow money. This is the table you relied on to determine what their final rate or cost of the mortgage would be.
Correct. So technically, this is the chart that all the lenders, all the loan officers were using for any agency type of a loan.
Right. So Fannie and Freddie,
Fannie,
but there's other lenders out there that this would not apply to.
Correct.
But Fannie and Freddie have a big chunk of the market, right? So.
Of course, yes. So that's what we will have to follow.
And just so everybody is aware, Fannie is not the primary lender.
Yep.
They are a secondary mortgage lender, I guess you would call it. They buy mortgages from companies like Washington Trust, and then they package them up and they sell them to investors, like mortgage-backed securities. So,
Correct.
right. So before we move on to what the new adjustments are, what's changed in this table? What are the two big changes that you've noticed?
So from this chart here, the credit score is pretty much, have a few categories for someone who has a credit score 700 or up. They break it down to 3 tiers here.
So the 740 category has been expanded into 3 more. We'll show that in a second.
Right. So this is the old chart here, but in the LTV wise, they don't have a much different. It's the loan to value ratios for someone, it matched to this credit score, what borrowers buying power, how much down they can afford, and then it will be based on that to adjust the rate accordingly.
So when you get a loan, you get, so mechanically how it works is, I guess Freddie Fannie has a base rate that you start with, and then based on this chart you add what you would add. You would adjust the rate. So I think the current, what's the current rate, 30-year rate?
So today's rate, 30-year fixed, is at 5.875 at par.
And that's a 30-year fixed?
30-year fixed at par, meaning no
adjustment.
No adjustment, yes.
Okay, so in this example, I'll take an easy one. If I'm in the 700 to 719 credit score range, and I'm going to put down a little more than 20%, but less than 15. Or actually, that's less than 20%, between 15 and 20.
Correct.
I would add a point. You would add a point to that 5.875.
So that's the old chart.
That's the old chart, right?
Yes.
Right. But I just wanted to just walk through mechanically how it works.
Sure. Yeah. So the rate will be based on the par rate, and then the add-on will be based on the credit score and the down payment size.
So if I had a 700 credit score, let's say my credit score is 700, and my down payment was, let's say 15%.
Okay.
Then I would be
the
paying.
add-on will be 1%.
So does that base rate of 5.875, you would charge me 6.875 basically.
Basically, yeah.
Okay.
Yes.
Yeah, just mechanically how it works, because I don't
Sure.
think a lot of people. I know I had a general idea. Just one other question: is that the only way that you can do it, or can you have people pay points instead? Could I get the par rate, the base rate of 5.875, and just pay up front 1 point? Is that another way to do it?
Correct. So this is a question would be asking someone that how long they're gonna occupy the property, how long they're looking to refinance. If for someone that looking to stay the property for short term, it might not make sense for them to buy points and pay points upfront.
Right.
And to get the par rate, it might just as well to go with whatever the rate it is and not paying any points. But pay point is always another option to buy down the rate.
Yeah,
So
exactly.
if this is the scenario that someone who have to pay points to get the rate at par 5.875, then it will be 1 point, whatever times the loan amount. That's the cost that would be added up to their closing cost.
Right. And I think to me it's very analogous to refinancing, whether you should or not. Like if I'm gonna sell my home in a year, I'm probably not gonna refinance.
Right.
Because it's not going to make sense,
That's
because
it.
I got to figure out what my payback period is, or where I break even, how many
Correct.
years I have to stay there to recoup my savings, I guess,
Correct,
or
correct.
my upfront cost, should I say.
Sure.
Okay, so this is 2022, this is before May 1st, okay? And now we jump to the new chart, which is this. And I guess the couple things that we talked about, the 740 category, credit score category being expanded to 2 more.
Correct.
And then this is interesting too. It looks like they expanded the LTV. So I guess this would mean that a 70% down payment.
Right.
So where before it was, if you go back, it was 40%.
40%.
And you're basically paying next to nothing here.
Right.
If you put down 40% or more, right?
Yep.
And then here it looks like the new chart. It looks like you're 60%, that same thing. They've added more fees. So this looks like they're penalizing borrowers more. Okay.
Correct.
Okay. So So it looks like, I guess to use Sandra's word is they recalibrate the risk here. And intuitively, that doesn't necessarily, I don't really have a problem. I don't think most people have a problem with that. I think the real issue is this chart here. And maybe you could talk a little bit about this. And just so everyone knows, this is the variance between the before and after May 1st, 23 tables that we just looked at. And, want to just kind of walk us through what this is telling us.
Sure. So as we can see on this chart here, the credit score is expanding and adding additional 2 tiers, right? Now we see from 700 to 780, they break it down to 5 different tiers here.
Right.
And based on the each tier, there is different add-ons. So if someone's score is at 720 to 739, depending on what the down payment size.
Let's say it's 80%.
80%
Or 20%
20%
down payment, right?
Okay. So saying for someone credit score is at 720 and they put in down 20% for the down payment, the hit here is half points.
So that base rate of 5.875 now becomes 6.375.
375, correct. So that's the hit.
So it looks like and just to put it in context, I think the average credit score of, I guess, all borrowers is in the is it within this range of 700 to 720, I guess?
So I see pretty common is from 715, I would say between 715 to 740. I see most of my borrowers
Or in
score.
these three categories.
Yeah, it's in that category.
So the majority of borrowers are going to be affected by this.
Correct.
Okay,
Yeah.
So in this case, it looks like the charges are getting more onerous in the new table that the after May 1st LLPA.
LPA, correct. Yeah.
And LLPA just stands for loan
Loan level pricing adjustment.
or mortgage fees, I guess.
Yes,
Okay.
yes. Yeah,
Okay.
it's the same meaning. So, if we have to help someone to get a better rate with that scenario, it might be better off have them put down less down payment, saying 5% or 10% to get
How
a
does
lower
that-
hit.
So how does that make sense? That I always have to step back when I look at this chart. These are changes. So I think if you go back to the earlier chart, you'll see that in the 95%, they're still getting charged. They're still getting a charge, but it's less. They lowered it, and it just seems counterintuitive that. And this is the argument I think David Stevens and a lot of industry experts are making is it looks like the FHFA, is trying to shift the burden or subsidize the green shaded areas, which are the lower credit scores primarily, or the lower down payments, right? Which are all green, meaning that their fees are lower, apples to apples, right?
Correct.
And people with good credit scores are getting penalized. That's what it looks like.
That's the. This is the.
They're still paying a higher rate. But is that? Well, maybe we'll get. Well, I guess maybe they're not, because I guess you're going to talk about a situation where they won't be paying a higher rate. But this is. If you go back to this table, this makes sense if they look at this one category as the credit score gets worse, going down.
Correct.
These charges go up, which makes sense.
It makes sense.
Right. Higher risk, higher interest rates, right?
Right.
That's finance 101.
Correct. But this chart shows it here, the down payment side is pretty reasonable. It's from 15% to 19.99%. You see the increase or the adjustment is, it's in that arrangement 1.25, right? For
Right.
the 720.
But then it goes down to
But
lower
it
the
goes
down
down,
payment.
Right.
That doesn't make sense, does it?
Correct, yeah.
That seems like counterintuitive. Because the less money down, the less skin you have in the game, and I think most lenders would rather. I always grew up thinking the 20% was the golden.
The gold, correct.
The golden number.
Exactly. So with that scenario, if someone who has 20% might as well, to put down less to get rid of the adjustment.
Isn't that's strange, isn't it? It goes against everything you were taught. At least to me, it doesn't make any sense. But
Correct.
I mean,
Yeah.
so. But anyway, so we go back to this. So the red area is where the change is causing higher fees, and then the green is the lower. And again, it looks, the argument by the David Stevenses of the world is that this is like a politicization of the mortgage loans, where you're having the good people with good credit scores subsidize the loan. So anyway, so that's one thing. So these fees, these LPAs are being added to your base rate.
Yep.
So we go to the next slide, and these are additional adjustments that Fannie and Freddie want you to make as a mortgage loan. Why don't you talk about some of these and what's different?
Sure. So in this chart here, this is more focused on loan to value on the different type of a property.
Okay.
So previously we discussed the changes made on the primary residence. Now here the changes is on condo, investment property, second home, manufactured home, or multifamily. So the changes here is pre-May 1st, there is no DTI ratio involved. It's either you don't get approved or decline.
So the only change from before May and after with respect to this table, I'm not talking about the fees, but is this new requirement?
Correct. So the DTI ratio is the new add-on. Now if someone has a DTI ratio over 40%, based on the loan to value, there will be the add-on to that as well. So just so everyone knows here, with Washington Trust as a lender here, we're going to absorb the cost if there is anything increased at the end, if DTI ratio increase for some reason, for something unexpected, miscalculation, anything like that, we as lender, we're going to absorb the DTI.
So you'll pay instead of that? Okay.
Yes, instead of adjust the cost to borrowers, so we're gonna take that hit.
Okay. Well, it's very good of you. And this is the only now with DTI, is there like a cap where you can't get a loan? Like if it's like 50%, is like a what is that number?
So before this change, the DTI usually cap at 43. If sometimes it can be flexible to 46% depending on the reserve, right? So 43 usually is the idea. 46 you have to show some reserve, and you'll get the approval for that. Other than that, you're not just going to be either declined or approved. We will run the system that will tell us. But now with this new change, so if anything goes up to 40%, they're just strictly adding additional cost to that.
So DTI, just so everyone knows, is debt to total
Debt to income ratio.
And what are they using in the numerator? What's debt? I mean, I get debt. If you have a house loan, that would count, right? Like car loans would count?
Everything. Yeah.
If you had alimony or so, or
alimony, child support.
That would be debt. Okay.
Of course, yeah. Okay. All type of expense, it's considered your debt.
Okay. All right. So you start with a base rate, then you make adjustments based on the prior table and this table here.
Correct.
And then Washington Trust is decided that from a business decision that we're going to absorb the DTI impact, which would range from 0 to 3.7 or 0.375%.
Yeah.
3/8 of a point, I guess.
3 of the 8, correct.
Okay. All right. Good. Okay. Good. That's good. So